Welcome to Passive Investor Ed 2020, the ultimate virtual conference for passive real estate investments, presented by Elisa Zhang, Kavita Baratake, Raj Tekchandani, and Ramesh Nachiappan, with our keynote speaker, real estate advisor to Rich Dad Robert Kiyosaki and CEO of MC Group of Companies, Ken McElroy.
All right, so thank you so much, guys, for joining us today. And I have my honor. I'm really honored today to introduce our guest speaker, the keynote guest speaker, the legendary Ken McElroy. I'm super excited about this, and just share a little bit story about how I met Ken. That he probably doesn't know I actually met him in person. So. I haven't met him 2 years ago at an event, at my friend Tarl's event up in Seattle. And I was so nervous that I literally just said, "Hi, Ken, I'm such a big fan of you," and then just disappeared. So that's probably my story over there. And basically, I was so jittery because, you know what? Let me give you a little bit background on Ken. So over 2 decades, Ken has been experienced massive success in the real estate world. He has been involved in every types of real estate. He's involved in multiple different assets in terms of investing wisdom, and over $750 million investment dollar in real estate. Ken offers a unique perspective on how to get the big returns on investment. Ken is also the best-selling author, The ABC of Real Estate Investing, which is one of my Bible to read when I first started doing real estate investing. And he's also written many other books, such as The Advanced Guide of Real Estate Investing, The ABC of Property Management, and most recently his book on entrepreneurship, The Sleeping Giant. That's actually not the most recent book, guys. I have this over here, ABC of Buying Rental Properties. Really excited about all these books because education is a key to this, guys. As a real estate advisor to Robert Kiyosaki of the Rich Dad Company, hopefully all you guys have read Rich Dad Poor Dad, which is one of the eye-opening book for me, and Ken is a chapter contributor also in the new release, the Rich Dad book, More Important Than Money, entrepreneurs team. So he is definitely a champion and advocate for entrepreneurs and real estate investor. I'm actually in his little Ask Ken club over there too, and he delivers so much value every single time when he comes online and ask all these questions. We ask all these questions and answer all of them. So check him out at kenmcroy.com. And welcome, Ken. Thank you so much for joining us today.
Hey, thank you. I appreciate being on today, and hopefully we can help some people out and answer some questions.
Yeah, definitely. And then I can definitely see some relation here. I also live in Seattle. Now I'm actually in sunny Phoenix, where you are right now, just visiting. And we're gonna start with a Q&A formats over here. So Ken, I'm just gonna kind of fire it up to deliver value for all our audience over here. So Tony Robbins says success leaves clues. Our audience here today are in a place where, some of them are really confused, some are want to just get more information. How do you actually create a job? This is one of the biggest questions people always have, right? So Ken, can you share a little bit about your personal journey to reach such an amazing success? And then what are some of the key pivotal moments for you?
Sure, thank you. Well, I think I was I had a very similar path as a lot of folks where I actually got into college through a athletic scholarship. So it wasn't in the area I grew up. It's very blue collar, and it wasn't people didn't really go to college, and so I was lucky to go, and while I was there, I actually started managing property at the tail end of while I was there, just to pay rent, free rent. I figured, how hard could that be? So I was like, how could I get a free apartment and a little bit of money, and because I was racking up student debt and trying to figure out a way to pay that off, and didn't really know what I wanted to do. So I came into the business through property management, and that was actually a blessing now that I look back.
Yeah.
And I realized that the key to most investment real estate is understanding the numbers. You know, can you really get the rents? You know, what can you really do on the expense side, and how much capital work is there, and all the things, you know, those are the components. And so luckily I started there and worked for a big company in Seattle. That was my first and only job. And I worked for that company for a long time, and they kind of became the model for me to do what I'm doing now. And you know, while I was working there, it was great. But I was getting a paycheck. I was salaried, and I didn't own anything. And so then I started to use my own money, as you do, as a lot of people do. And then I ran out. You know, after a while, I was like,
how did you save up all
so
these money? I mean, as a property manager, you don't really make a lot.
Well, we were managing bigger projects, and you know, I was actually doing pretty well financially, and you know, in the firm that I was in. But even then,
Yeah.
you know, it wasn't much. I mean, you know, when I'm talking about down payments, this is back in the late 80s. So, you know, we're talking about $20,000-$30,000 down payments on things. And so, you know, it wasn't too hard to save that kind of money, but you run out, you know, at some point you run out, and so there's only so much you can do. And so that's when I learned that I had to learn how to raise money. You know, I had to learn how to do it more like a business. But I never, you know, I never ever jumped in just to do it full time. You know, I always had some side hustle going, always. And so I had a job at all times, and I was building my portfolio at the same time. You know, that way there wouldn't be pressure. And then the goal became, of course, how do I get financially free? How do I get enough passive income to cover my expenses? And so that's kind of the journey. And then I what I did is I just took it from there, and I said, okay, I need to scale this, replicate this, get bigger and bigger and bigger. And now we have, as you know, right around $1 billion worth of real estate. So we have multifamily, office, self-storage, and you know, we do land development. We have about 250 people now in my firm. So it's been an interesting journey. It's been really fun. I met Robert along the way, and a whole bunch of other characters, you know, and birds of a feather flock together.
Yeah, that's awesome. How did you meet Robert? I'm always curious.
Well, I was raising money, so, and he had it. So,
Yeah.
I mean, as simple as it sounds, I didn't actually know if he had any. That's the truth. You know, what happens when you find a deal, there's a lot of pressure to raise capital. I was in a group called EO, or Entrepreneurs Organization, and you know, which I really recommend people take a look at, because you know, if you want to build a business, that's a really good resource. And one of my friends that was an EO with me knew Robert, so he had written this book called Rich Dad Poor Dad, and it wasn't the success that it is now. I mean, this is back right when it got released. And I said, okay, great, I'll meet him. So I went to the bookstore, bought the book, read it before I met him, and it was a quick read, and then we sat down and we connected. You know, but we spent a good year before they invested in anything. Kim and Robert, you know, we went to properties and all that. So he kind of got to know me. I kind of got to know him, and you know, he said, you really need to teach people, you know, what you're doing. And I said, you know, I wasn't at all interested in writing books or talking or speaking or doing any of that. I was just interested in buying real estate. And so I went to one of his, he invited me. He said, hey, can you come speak to our group? He had a big event somewhere. And I said, sure. And I went, and I enjoyed it. I really enjoyed it, because I was just saying, hey, this is what I'm working on. You know, I realized that there's a pretty big need and people that are kind of on the same path and journey as me. And then maybe I had a little bit to provide and give back to people. So that's why
Lots
I like to
more.
do it. Yeah.
Lots of more to provide. Lots of more, Ken. Always great to kind of listen to you on your wisdom. Like 5 minutes with you, it's like 50 years shaved off my career. Why real estate? Why did you pick real estate? I'm guessing you kind of, because it's property management, that one's kind of no brainer for you. Yeah.
Well, but see, I invested in the stock market. Yeah. I had money with a wealth manager. I threw money at a gold mine. You know, I tried to day trade. I've tried a lot of different things in this journey. And the one thing that was always consistent, you know, was that those little rental properties, you know, they were always, as long as I had people in them, you know, and they were happy. You know, I was like, man, you know, all this other stuff. And it's hard to understand, like, what's going to go on with gold, what's going to go on with the stock, you know, who to trust, you know, what are their fees. And so the one thing that I always knew is, okay, I could take, you know, my down payment and I can calculate what I'm making. And then after I started doing that, obviously I learned about all the tax benefits. So there's one, the cash flow was, you know, I couldn't figure out how to cash flow other things. In other words, how do you know, I know Andy Tanner, he's so smart, you know, he can cash flow stocks, you know, but I didn't know how to do that. You know, and a lot of the stuff was kind of wait and hope, you know, hope that it goes up. And I didn't like that strategy. So I like that. I like using leverage, obviously. So you've got the cash flow, you've got the leverage. Mm-hmm. I love using what I call OPM, or other people's money. Yeah. So, you know, we're putting a deal out in a couple of weeks. It'll be a $20 million raise, you know, and I'll throw money in, my partners will throw money in, and then we'll raise the rest from, you know, private investors. Yeah. And so I like having that, being able to, you know, do things that way. Mm-hmm. The tax benefits, oh my gosh, you know, just being able to own property and then depreciate them and to have, you know, tax-free income. Mm-hmm. So these are all things that I learned later. And then the asset protection, you know, that was the other thing. Like, yeah. I've had properties burned. I've had properties, you know, in tornadoes and hurricanes and stuff like that over the years. And you know, if they're insured, asset protection wise, yeah. You know, you get them rebuilt. And yeah. So I just found that it's just kind of, it's just a great way to financial freedom, because the other stuff to me is just super confusing.
Yeah. Yeah. That's kind of, I agree with that. Every time I've invested in a stock, I lose money. So stay away from it. Hey, Ken, I know you have shared a lot of these wisdom in, you know, the Q&A sessions that you host and et cetera. But can you share with our audience today some of the trend that we're seeing in the market right now? You know, this whole pandemic thing is not going to go away anytime soon. I did a survey before. What do you fear for? And a lot of people have said, hey, 2020 should end already. But, you know, we know this is going to continue going on 2021. So what do you kind of see in the market trend? But more importantly, kind of how do you make a lemonade out of a lemon? You know,
right. Great question. I think it's a confusing time for everyone. But I will say it's not that hard to make money when the market's trending up. I mean, you know, everybody looks good in the last few years, really, truly. And that is not because everybody's super smart investing. This is actually when the education kicks in. Is you know, it's not that difficult to buy something, and you know, and you know, a couple of years later, oh my God, it went up. I mean, that is not what we're trying to do here. Right. So, you know, the key to this next piece, where we're heading, this is actually where real wealth will be made, in my opinion. So the times that I've made the most money has always been in the downturn, hands down, period. Yeah. You know, and so that's where we're heading now. We're heading into a downturn. I think people just need to wrap their heads around that. You know, we have unemployment is very, very, very high. I just did a really good video on unemployment on YouTube, on the different kinds of unemployment. You know, so the federal government they report what's called U3, but the real unemployment rate is U6. So you can go and check this out on BLS.gov, which is the Bureau of Labor Statistics. And you can kind of get an idea of what the real unemployment rate. And the reason why that's important is because real estate exists for people. And if people don't have jobs and they don't have income coming in, then those areas are going to be hit harder than ones that are. And so you really, if you're going to invest, and wherever you're going to invest, you need to make sure that there has a really, really good job base and it's growing. And people are moving all over the place right now.
Yeah.
So it's very, very, very confusing. But if you can, it's submarket by submarket. What people want is they want an answer. They say, invest in Denver. That's what they want.
Yeah.
But that's not a solution, because downtown Denver is different than all the suburbs, and there's submarkets within the submarkets. So that's what people want, though. They want the easy answer so they can get on a plane and throw money at it. That's not how real estate works. It's very temperamental. An employer can literally go out of business during this next 12 months, or a regional mall or whatever it is. And that severely impacts, has ripple effects in that particular area. So, but that lends itself for redevelopment and repurposing. And that's where people start to make a lot of money. So when I started doing value adds in the early 2000s, no one was doing value adds. There was no value add market because there was a bunch of foreclosures. People had lost a lot of their real estate, and so we were just buying them for big discounts. There was no, hey, let's put $5,000, $6,000, $7,000, $8,000 a unit in it and try to get a $100 bump. That did not exist because there was no rent growth at that time. And so as you start to see things, like these regional malls or some of these hotels that are going to struggle and go back to the banks, the key for this next chapter is going to be, what are the opportunities around the failing real estate, and how do you repurpose that? How do you redevelop areas? How do you turn a hotel, let's say, into assisted living facility or an apartment facility, because it's already built? How do you take a regional mall and redevelop that, and how do you put the pieces together? And I know those are big projects, but that's what people need to be thinking about next, is take a look at the trends that are obviously driving things down, and take a look at the ones that are driving them up. And this COVID, this pandemic thing, I like to tell everybody, all it did was accelerate things. It basically took what was already happening already. I mean, retail was already in trouble because of Amazon and all these online retailers. It was already in trouble. And, and so all of that was already moving forward. And what it did is it just condensed it and made it a lot quicker. So I think there's going to be lots of opportunities around college universities. I think college universities are going to be in big trouble. If it was a short-term thing, I think it would have been business as usual. But I have 2 kids in college, and I have a lot of friends that have kids in college, and the kids are not happy with the online Zoom learning. And the colleges haven't quite figured that out yet. And, they have to do it that way because of, what's happening, and we got to keep everyone safe. But I do think that that's going to change a lot. It's going to change a lot of behaviors, because kids are locked into their renters, their rentals, they're locked into their dorms. And if this thing gets kicked into next year, late into next year, I think you're going to see a massive difference in enrollment. And so all that's going to turn into real estate plays later. And so all of those things, it'll affect the rentals in the area, all of those kinds of things. I think you just need to keep your eye on.
Yeah, student housing, because I've heard a lender talked about student housing this year. Oh no, we don't want to lend anything on the student housing, because the uncertainty. But there
Yep.
may be massive opportunities, as you said, for repurposing, and we kind of already see some of these downtown offices getting repurposed into condos potentially. So these are kind of some stuff to kind of watch out for. That's amazing. So I don't think they finished counting it. I don't really know. I don't keep on account of that. But depends on the election outcome. It may create an impact to our investment strategy as well, because the other big part of it is tax, right? So Ken, how do you kind of see this trend going in terms of where the puck's gonna go with that? Yeah.
I get a lot of questions around this. I think a lot of people they think that a change in the president is going to create all these massive issues. I don't agree with that. I've owned properties, from Bush to Clinton to Obama, now to Trump, and yes, there are definitely things that each administration does. There's no question. And there will be things that they eliminate or add, and all that stuff is going to continue. But I think, if we're going to specifically talk about, let's say, if Biden wins, which it certainly looks like that might be the case, there are going to be some things that you need to be concerned about. I would say the two that come to mind would be the capital gains tax, and then the estate tax. So, but who knows? There's a bunch of obstacles around that. I know, there's probably more, but at the same token, I think that he'll probably, if I was a betting man, my guess is that he'll probably put some tax incentives around green energy. Okay, well, there's a lot of ways that you can take existing properties and make them more energy efficient and get all these big tax breaks for, and we're already doing those things personally. So when we're talking with lenders, we actually get incentives on the loan rate by doing energy efficient programs inside of the units. And so I think, certainly they're going to have their own agenda and they're going to have their own policies of things. But at the end of the day, it's going to be very doable and very workable, and it's not going to be anything that we haven't seen before. I think they probably the next administration is going to be a little more pro tenants. They're going to be giving tenants money, which, is good for landlords. If you go back and look at tax credits, or you go back and look at Section 8, for example, those are programs that people need and use. So I think you're probably going to see a little bit more around that. But, I think the big thing that people, I always tell people, if there's one thing that you really need to be concerned about moving forward, I actually think it's property taxes. So I think that, as these big cities, are losing people, and, they're moving out of let's call it the urban cores, moving into the rural areas and pushing the prices up on a lot of stuff. The cities are responding. They're levying big property tax increases. And so as and that's part of the financial analysis of buying a deal. So you really got to pay attention to, what property taxes are doing, because that's kind of low hanging fruit for a local municipality. I think Nashville increased already either 32 or 34% property taxes. So, and those are, if you're a city, that's what you're going to do. If you're losing your tax base, to somewhere else and people are moving, you're going to raise the tax on the people that are there. So, those are the kinds of things that I think that everyone should be concerned about and watch as we start to see people moving around.
Gotcha. Yeah, so if you live in Seattle, like where I live, you gotta be like, watch out for more tax increases, because people are moving out of the downtown core as flock. That's awesome. So last kind of question over here, and then we want to wrap it up, and so we can answer some questions from the audience. I think it's the chat box is going off here. So as an investor, what is a process you use to pick the next right investment, regardless of asset types?
So the next investment area, you mean?
Yeah, so like like the next investment area or the types that you invest in, because I
Sure.
understand you invest in multiple asset types. Yeah.
Yeah. So I think, a couple things. One, it's really important, I think, to try to be an expert in whatever it is that you're doing.
Mm.
So if you can, for me, I do multiple things now, but for years, I just stayed in the multifamily lane and that's it. And when we decided to jump into self-storage and we decided to jump into office and we decided to jump into some of the other things that we've done, the learning curve is like this. It's no different than anyone else. It has different, different, it operates differently. It responds to different metrics. When you buy, the returns are different, the lease ups are different, the construction costs are different, the operational costs are different. So it's very, very, very different. And so like an office building, when a tenant moves out, you might have to spend $50,000 to $100,000 for the next person to move in. Right. So those are real cash in and out. With multifamily, you just a couple,
Yeah.
you do your maintenance and paint it and move somebody in. And so there's a lot of differences and a lot of nuances. So, but with that being said, to answer your question, you gotta take a look at what the market needs and then solve that problem. So maybe the market needs some assisted care. Maybe you have an area where a lot of assisted care facilities are full and there's waiting lists and the prices are going up. Okay, that's a supply issue. And that can be very different 5, 6, 10 miles away.
Yeah.
But in that particular submarket, that might lend itself to another assisted care facility. Same thing with self-storage. So if the self-storage is completely full and there's a waiting list or they fill up very quickly, then that obviously lends itself to the potential of putting up another self-storage. So those are really supply issues and demand issues. And so when we're looking at anything, whether it's single family, multifamily, industrial, commercial office, or whatever it is, you have to look at that particular little submarket. And, you can't just say, okay, I'm a self-storage guy and start putting them all over the place, because some will work and some won't work. Some will be harder than others. And so you have to dig deeper about the opportunities in an individual submarket and be really sure around that. And so from a renter standpoint, I think one of the brightest spots is multifamily going forward and renters, because, we have all these big forbearance issues right now that, with the CARES Act, where, people, they said they couldn't come back to work or they've been furloughed or they lost their jobs or whatever it was. We got right around 4 million people in that category, and 2.5 of them are 2.5 million are 90 days delinquent or more. So, what that means is that just like in 2008, that's going to create more renters. People are they're going to sell their homes, or if they're 90 days delinquent, it's highly unlikely that they're going to be able to stroke that check to cover that. And it's in many, 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 many cases, the lenders are not going to throw it on the back end of the loan. That's called a loan modification. So that means they have to go back in. It's almost like a refinance. Right. So in some cases they will do that. I've been hearing some lenders are, it's lender by lender. But when all that ends, it's going to push people back into the rental market like we did in 2008. And that's actually why we got this big rental run. So, the homeowners that lost their homes in the early 2000s, let's call it 2008, 7, 8, 9, 10, 11, that actually put a fair amount of pressure on the rental market because, as people dumped out of single family, it put pressure on the supply.
Yeah.
There's more demand than supply. So that's why we got our rent growth.
Yeah.
And so, but everybody jumped on board and they forgot about all that.
Yeah.
So that's going to happen again, I believe. And then, it's going to, again, give multifamily and rentals a nice little boost moving forward. So I'm
Yeah.
really bullish about rentals.
Yeah, really looking forward to that too myself after hearing you talk about it. Great. So we're going to cut over to the audience and answer a few questions from them because they're all dying to ask all these questions. And we can't get to everyone. So sorry about that because we got lots of questions over here. So I'm going to start from the top. Some of the top questions. Thank you, Kavitha, for curating them. What would be the top 3 tips of passive investor beginners? Because we got a lot of people who kind of just get exposed to passive investment right now.
Sure. Well, I think the biggest thing is, if you don't have any money, which is kind of where everyone starts, and you don't know how to see a deal, then you have to figure that out. Obviously number 2 being the most important, and being able to see a deal is pure education. So as I drive down the road, I'm looking at a vacant building, or this or that, and my mind's flying, going, okay, I can do this. I'm sure you're the same. Well, that comes from experience and education and being around people that see things that way. So I see a vacant building, I'm thinking I can steal that, and if I get a tenant in there before I close, it's worth more money. Common sense, simple, but so when you can do that, when you can see things that other people don't see, then raising money is really easy, because you can say, listen, I think you might have heard my story about the billboard. I own a bunch of billboards, and I started buying them because billboards are real estate. They're two-sided and they cash flow, and they don't require overhead.
Yeah.
There's no people. So so I saw a piece of land, had a billboard on it, and I was interested in the billboard. Everybody else was interested in the land. So I called my billboard buddy, and I said, hey, is this a good location? He's like, oh my gosh, it's great. I go, what do you think you can do on it? He said, I think we can do easily around 4,000 a month, 2,000 on each side. I said, okay. So, and it was doing 5,000. So the land was only 300 grand. So I bought the land. I put an easement around the billboard, we got it to 4,000 a month. And then I sold the land for 300,000. So now I have the billboard for free, and I'm generating around $4,000 a month passive income. And so again, it's what you see. I saw the deal and it came through. I'm like, okay, what can I do here? And I'm not a billboard guy. I'm a real estate guy. But for me, I was like, how can I figure out a way to generate passive income just like everyone else? And that deal it went out to thousands of people. Thousands of people opened that property.
Right.
Thousands of people were looking at it. And so that's it. It's the education. It's what do you see? These deals start in your mind, and what people don't realize what they miss. So when you look around and you see the cranes in the air, and that's somebody saw something.
Right.
Somebody saw and put the money together, put the construction together, put the architects together, and they're building the buildings. And they have a different set of skills. So those are, when I drive around, I'm always curious. You have to stay curious about everything. What can I put on this corner? What can I do here? And that's how I approach it all. And so if you're not seeing opportunities or potential, then it really boils down to education. And then once you can package that up, if I didn't have the money for that billboard, I mean, I'm going to be able to get it. Like, I'm going to say, listen, here's the deal. We're going to buy the land for 300. I don't have the money. Here's the numbers, and here's, what this billboard's going to be able to do. Here's the plan, and we're going to sell it. So, that is not hard for an investor to figure out. Mm-hmm. So, those are the kinds of things I think that if you're just starting out, you got to start with education and get around groups like this, mentors, that can help assist you on seeing those kinds of deals.
Yeah, and get exposed, go to events like this, get exposed to different kind of doing a sampling of like who do you want to mentor be and etc. That's awesome. All right, so we don't have a lot of time for all the question. I'm gonna do like quick rounds. Maybe we'll get to 2 or 3. So how to transition from the employee mindset to investor or business owner mindset?
Wow, this is a good one. Well, as you guys all know, the ESBI, which is in Rich Dad Poor Dad or Cash Flow Quadrant. If you haven't read the book Cash Flow Quadrant, I would definitely take a look at that. There's a lot of really, really good pieces in that book around, employee, how to move from employee to investor. It really is education. Again, going back to that. Most people are, they get very comfortable with their paycheck. They get very comfortable with their habits, and nothing wrong with that. I'm just, and so it's again what you see. So you have to. I see being as an employee. I see being relying on somebody else for my paycheck as a massive risk personally. In other words, I'm basically hoping that the company stays open. I'm basically hoping that the company is growing, and some are doing very well. And I'm not ever suggesting that people leave their jobs. I suggest that they get educated and they start doing the side hustle. My sister is a great example. She was a bookkeeper. She never went to college, and she was a bookkeeper at the Everett Clinic, which is north of Seattle, which is where I grew up. And she did not make a lot of money, but she owns 5 rentals now, and she just turned 60. And she did that over a long period of time. She saved up some money, bought a rental, saved up a little more money, bought a rental, and so now she's got millions of dollars in rentals paid off by her tenants, and she did that just by chipping away. And she was an employee the whole time. And then eventually, once she had a few of them, then she decided to leave her job as a bookkeeper and become a real estate agent. But the reason that she did that was so she could find more deals. So, she did leave that paycheck, but she did it only after she had that monthly income coming in from the rentals. And so, it doesn't have to be something that happened in a year or two. For her, it happened over a 10 or 15-year period, and she did it very slowly. And honestly, she's financially retired as a result, because those deals are almost all paid off. And she's got massive cash flow coming in now every month. And so it just takes time. It's a long game, and I think a lot of people want it to happen now, and they want it to happen immediately. But I think you got to understand, even myself, these are long ownership cycles for us. We don't like to sell.
Yeah, yeah. If it's making money, why would you sell, right?
Right.
When you making money when you sleep.
Right.
Yeah. So okay. So next question. And I think I got the clock screwed up a little bit. So everybody, you actually got a more bonus, Ken. So Ken, you're actually sticking with us for another 20 minutes. So great question. So next question that I have over here from the audience: if one has 100K liquid cash, where to invest? Where to invest the money?
So I get this question a lot. People want that answer. Um, I would be very careful of asking anybody that question, to be quite honest. I mean, it's a truthful question, but there are more people that will take that money um, than you probably care to know about. So, the real question is, if you don't know the team, the property, the fundamentals behind it, how the cash flow works, and all of that stuff, then then I would imagine that it's just a pure hope thing. So, and I'll give you a couple examples. Through tax planning and stuff, I have money in, 401ks and stuff like that, even though I'm not a big fan of them. But I do have money in, defined benefit plans and 401k plans and things like that. And, quite a bit of money. So once a year, my wealth management guy calls, and he's like, I think you should invest in oil, one of the phone calls. And I said, why? He couldn't answer. Yeah. And it was fee driven, right? Because there's incentives, people are driven by money and fees. And so somebody's going to take that 100 grand from you, and it's going to be self-serving for them. Mm-hmm. And they're going to sell you on what they think. Now, it could be right, but I would be very careful, on asking that question. I think the better question, even though it's a very, very legitimate question, the better question is if I invest this 100,000, what kind of return will I get? And show me the details. You know what I mean?
Yeah, love it. Yeah.
Because everyone's going to take that money, and so the level of experience that if you're going to invest blindly on somebody, then you need to know that there's a lot of risks. Mm-hmm. There's a lot of risks either way. But I had I'll give you a good example. I have we have a lot of investors in our investor database. I have investors call me, and they'll spend an hour on the phone with me on your team, the market, where's the rents going, what's the expense side, when do you expect cash flow, what are the tax benefits, and I really appreciate those questions, because that's somebody that's taking an extra step to really understand where their money is going to be. Mm-hmm. I also have people that just wire the money and never talk to us. So no, it's true. I mean,
but they did probably all the research on you. They're like, okay, well,
I hope so. Yeah, I hope so. But I'm just saying, so I've been there. I did this right out of college. I gave a wealth manager money, because he showed me all the tables, and if I compounded interest and all the stuff, that they always do with all the numbers. If you hold on to this for 20 years, it's going to be X. Well, 10 years later, it was like the same amount of money.
Yeah.
And so it depends on where it's invested, and what it's invested in. And so there's a lot of things. So the education, you got to manage your own money, period. You have to know, and you're still going to make mistakes. But if you're just going to give it to somebody like my brother did this, I asked him, he retired recently. I said, how's your stock portfolio doing? How are you doing? He's like, I don't know. I haven't talked to my wealth management guy for a while. That's the mentality of a lot of people.
Yeah.
Scoop my money through these monthly paychecks, and maybe I'll have a meeting with my wealth manager every once in a while. I don't know what kind of fees they charge. I don't really even know where it's invested. Maybe I open my quarterly statements. It's just, it blows my mind that people work their whole lives, turn their money over, like my own brother, and don't really know where that money, how that money's growing,
Yeah, definitely. So taking control of your destiny, which is why you're here this weekend, because then you're taking your first step to kind of really learn more, and there's more follow-ups to kind of really learn from that. Next question that we have, actually right down to that T, is you talked about education, but a lot of folks are busy professionals. So how do you actually set aside time for learning? You're super busy, I know. Like, how do you set aside time to learning?
Yeah. I think this just comes down to priorities. I've found that at every stage of my life, I believed I didn't have the time. Here's what I told a young man the other day. I was playing golf with him. I said, young man, you just got kicked out of your job in March. So how much more time do you really need? like, really, like, you know what I mean? Like, if you
Yeah.
can't find time during a pandemic, like, really, so that's what, you know what I mean? Like,
Yeah.
so that's when I started my YouTube channel in March, and now we're like somewhere around 140,000 subscribers in 6 months. And so, there's plenty of time. It just boils down to priorities. Now, listen, I have multiple businesses. I have, kids that I've raised. I coached, my kids, in sports. I was busy just like anyone else, and so it boiled down to my priorities. And so, anybody can read a book or watch a YouTube video every day for 10 minutes. I mean, that's all it takes. If you watch one YouTube video for 10 minutes, it doesn't have to be mine. It could be anything. And anybody can do that. Come on. I mean, you know what I mean? Like, so I always laugh at this question, because I think people really believe that they don't have the time. I don't agree with that. I think that there are some extenuating circumstances, of course, but there's always time to chip away at things. If you watch a YouTube video every day for 3 months, for 10 minutes, you're going to be massively more educated than, I'll give you a few things that I do. I go see my son. He lives in Tucson, Arizona, because he goes to the University of Arizona.
Yeah.
That entire year, hour and a half, 2-hour drive, I specifically find things that I want to listen to, on my way down there. I could listen to the radio, I could do whatever I want to do. It's how do you prioritize your time? So, there's a lot of things people do differently. Some people come home and watch TV and then go to bed and get up and do the same routine. For me, I like, I like to go to the gym. I like to eat healthy. I like to visit my kids. I like to, I manage my companies. I create time for learning. It's a massive, massive priority for me. So I don't buy into the time thing.
Yeah, so manage it really well. And sometimes it does take some exercise to prioritize. I think the one thing is a really good book to potentially to kind of follow up on in terms of potentially prioritize that. Cool. So Ken, I've got a couple more questions from the new investors. Well, actually, this one's probably more a question I want to ask too. For the next 5 to 10 years, which asset classes you're planning to invest personally and why?
So I think that rental housing is going to be an incredible asset class long term. And I believe that because, if you take a look at people, if you look at President Bush, so I own properties and invested properties, and he's a Republican. He pushed home ownership. I don't know if people remember, but in the late 90s, early 2000s, that was the thing. Everyone needs their own home. Okay, so home ownership got really high. I think up into the 69, 70% range or something. And it came from like 62. Well, so it does, again, back to it doesn't really matter what the policy and administration believes. That's what's going to happen next. So I think that, we're going to see a massive demand for more rental housing moving forward, because businesses are going to, people are doing business very differently now, and I think that I think we're going to have this rental housing boom. Interest rates cannot go any lower.
No, yeah.
And prices are high as could be. They're at all-time highs right now. So I think that's one thing that is going to be something to watch. Another one I kind of touched on it is, the baby boomers are getting older and they need assistance. So there's going to be a pretty, if you just follow the math of people, I think it was something like 50,000 of them retiring every day.
Yeah.
And right now they're pretty active. They were going on cruise ships and, traveling and things like that. That's why those businesses were so vibrant.
Yeah.
I mean, people retire, everybody, for whatever reason, that's their big thing. they work their whole lives and then they retire, and then they got this little window and they do whatever, what we all know that they do, right?
Yeah.
So they go on these vacations all over the place, and that's what, that's what we just witnessed. That's all going to change. But everything related around anything that has to do with medical or assisted care or pharmaceutical, that kind of stuff is going to do very, very, very well, in my opinion, moving forward.
That's awesome. And then we have a session later on today with Benny on the senior living. So that's awesome. Definitely tune in for that. And thank you very much for your knowledge. Lisa asked, in all your years of experience in going through downturns, what would be the top couple things you would have done over or caution new investors on?
Very, very, very good question. So here's what takes people out during downturns. There's really just a few. Obviously, no tenants. So that's, pretty obvious, but not to a lot of people, oddly enough. So if you have anything that you might think that could be a problem later, a business that's closed and might not reopen, those are the kinds of things that you probably need to sell or exit right now if you don't believe in that long term. Pretty common sense there. The biggest one by far is recourse debt. So what recourse loans? So what that means is when you borrow, to buy something, you actually put all the collateral that you use is all your other assets. So it's called recourse. So if the deal itself does not do well, the lender will get that deal back, but they'll also go after your other assets to pay themselves back. So there's recourse debt, and then there's non-recourse debt. So non-recourse debt is what we use, but I've seen lots and lots and lots and lots of people lose everything that they've gained by having recourse debt. And lenders are, they want you on the hook. If something goes bad and the loan can't be paid back, they want to be paid back. And so they go after your personal assets. So I've seen a lot of personal friends go down during downturns that have a lot of recourse debt, and they can't pay it back. And so everything that they've gained gets paid back. And in many cases, they have to file bankruptcy and get asset protection and all those other kinds of things. So those are the two things I would be careful of.
Gotcha. So get into non-recourse debt if you can, or sell them and get that. Awesome. And I think we have a couple other questions if you still up for answering them. Why are you not a fan of 401k? Or are you a fan of 401k? I think it's someone just assumed that you're not a fan of 401ks.
Well, I think you got to dig a little bit deeper about again, for me, it boils down to what 401k does is it makes people lazy, and also it's pretty heavily fee driven. So, and there's all kinds of taxes if you pull it out. So essentially you get locked in. Yes, you get some tax benefit, but you have to keep it there. So basically you're creating fees for the financial industry, financial planning industry, or wealth management, or whatever you want to call it, for a long period of time. You're locked in unless you take it out. And so it's your money. So, so I think that probably I'm probably not giving this topic the justice that you really need to go and look at a book called 401 Chaos, and start to take a look at some of these books that like Andy Tanner wrote. And he can walk you through what's really happening in the 401k industry. It was originally not supposed to be the plan that it is. And so what it's turned into be is a great way for Wall Street to take employees' money and manage it over a long period of time without much interaction from them or even knowing where it's going. So you can make money in the 401ks if you ask the right questions and do it correctly, but most people don't. It just makes people lazy. So I'm
Yeah.
not a big fan. I do have them, and
Yeah.
but that industry is all largely based around fees.
Mhm.
How much money they can make off their clients.
Yeah.
And I don't, that's, there's
Right.
nothing wrong with that. There's nothing
Yeah.
wrong with that. But just you need to understand how it works, and then
The
challenge the real
incentives.
data.
Yeah, the incentives, where the money, follow where the money goes.
Yeah.
Is some for workforce sorry, if some workforce multifamilies are going to suffer due to eviction moratoriums and potential double dip recession, how do you think about timing when to buy? No one gets the bottom, right? Or are we gonna see a bottom? Like you mentioned, that the multifamily may be going for a good run here.
Yeah. It's going to be hard to know. It's going to be based on, so again, it's really difficult to say multifamily is going this direction. Really, what you need to look at is the financial structure, the leverage, the liquidity for individual deals. So in other words, you could have two deals side by side in the exact same town. One has 60, 70% leverage, another has 80. One has cash, another one does not. One's managed well, another one does not. So you have to really look at each, the submarkets and how they're capitalized. Those are the kinds of things that you need to look at. So in the last downturn in 2008, you know, we were able to get lots of properties from banks and from lending institutions directly that they had taken back, and they were right next to other ones that were doing fine.
Mhm.
And the reason is because of the financial structure that particular ownership group had. They weren't able to hold on to it. So it's going to be based on the operations, and not necessarily is multifamily good or multifamily bad. So the ones to look at would be the ones that were bought in the last couple of years with big value add stories.
Mhm.
So hey, we're buying this and the rents are 1,500, and we're gonna grow them to 2,000, or
And
let's
no
say.
cash flow. Yeah.
Yeah, right. So those are the ones you're gonna watch because they probably overpaid, uh, initially, with the intention of growing the value massively, and that may or may not happen during this period of time for them, especially if it's, let's say, an area that's high hospitality,
Mm. Yeah.
like, or tourism, or you got to kind of go back to the job base in that area. So, or maybe next to a university, or maybe student housing. And, the reason lenders aren't lending to student housing is because of potential
Yes.
issue. I mean, so
Yeah.
so those are the kinds of things that But as you know, market rate housing just a couple miles away from that might be really, really good because maybe it's next to a hospital.
Yeah.
So you have to. It's really a case by case basis, and you have to dig in. That's where the opportunities are gonna be, is in all those little nuances at the submarket level.
Yeah. And then, so to that point, I think this is awesome session. I think our listeners love this, because you never just get Ken to ask questions on, like, what do you think about the stuff that maybe thinking about investing. So we're gonna probably wrap it up on we got two more questions, and then we're gonna wrap it up. And sorry, we can't get to everyone's questions over here. What do you foresee happening to commercial given the high rise in online sales, working from homes now being the norm, and other factor that decreases commercial rental? Because that's going to be a down sector, right? But that could potentially be where the opportunity is.
So I'm just going to make a guess that they mean commercial office. So,
Yeah. Commercial
so
ownerships.
yeah,
Yeah.
so well, I mean, you just got to think about, it. There, I think, the best example is San Francisco, in my opinion. Pinterest just wrote an $89.5 million check, 89.5 million dollars, almost $90 million to get out of their lease. You look at companies like Salesforce, Twitter, any of the companies that are, in those areas, and for sure, they're not coming back. They've already said they're not coming back. So obviously, whoever invested in that building, and there are investors, and whoever put debt on that building, that's all going to make its way through, the financial markets. It's going to ripple. So, but I do believe that, if companies like that are easy to pick on, but the truth is, at some level, most companies are going to have some kind of a corporate office, and it's going to be watered down though. It's going to be a lot smaller. So we're starting to see, people that had maybe 10,000 feet going down to 1,500 or 2,000.
Yeah.
And I think you're going to see that over a period of time because, again, going back to office, as we own some, those are 3, 5, 7-year leases. In some cases, 10. So these are leases like with Pinterest that you could write a check and break, or you have to kind of wait. And so it's going to be very, very interesting. But I do think commercial office is going to be a problem in many, 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 many markets over the long haul.
Gotcha. And then so would they just torn it down? What are some opportunities over there then that you see? You see, of course, not all of us can see it. Yes.
Yeah. Well, I think, the regional mall is another great example. A vacant office building. I literally remember this conversation with, of all people, Donald Trump. When I was in New York with Robert, we were backstage and speaking in New York, and he literally bought a vacant office building in downtown Manhattan for $1 million. Now this is a long time ago. This is like in the 80s.
Yeah.
1 million, 100% vacant. And he said, all I needed was one lease to cover it.
Yeah.
Okay. So again, now that thing's worth whatever it's worth. Yeah, I don't know what it's worth now because that was pre-COVID, but you get the point. Like, so now, could they be torn down? Sure. Is that the highest and best use? Probably not. But I think they'll probably get repurposed. I know people that are converting office buildings into condos. I know that people that are converting them into rental housing. I know people that are converting them into assisted care. Who knows what the uses are going to be, over the long haul. Some could sit vacant for a long, long, long time. They're going to sit on the lender's balance sheet as a defaulted loan, and as a toxic loan or REO or real estate owned. And until somebody comes along and like again sees a use for it.
Yeah, gotcha. Awesome. So we wanted to kind of wrap it up over here. Hopefully all you guys loved this. Rarely have Q&A session with Ken because the time screw up on my side. And if you like it, give it a thumbs up, raise your hand, give applause to Ken. Thank you so much for all this great question. Every time I listen to him, I always learn so much. So Ken, how does people find you? Kavita, can you bring up that slide for Ken?
Sure. Yeah, just go to kenmcelroy.com and I think you'll see everything there. We have a number of things from podcasts to YouTube to videos and free downloads and things like that we've developed for people as they're moving along in their journey. So I appreciate that. Thank you.
Yeah, thank you, Ken. And then I can assure to this, I'm part Ken's group, and he gets onto the call and answers every Monday for about 30 minutes. That was like the best 30 minutes of my life for that week. Thank you so much, Ken, for all the value you deliver to us. And hopefully you guys are really excited for the rest of the day because everything kind of Ken talked about, there's a one session deep dive into them. I just love this whole session. Thank you so much, Ken, for your time.
Thank you for joining us. Don't miss out on Passive Investor Ed 2021. Get your pre-sale tickets now. For more information, please visit us at www.kenmcelroy.com. www.passiveinvestored.com.